Hi friends, in this lecture we are going to discuss three more fundamental accounting concepts. In this lecture I am going to discuss about the periodicity concept, the cost concept, or it is also called as the historical cost concept, and I am also going to discuss about the revenue recognition concept. Okay, now let us take up each concept for discussion separately. Let us discuss the first concept, the periodicity concept. Now, what do you mean by the periodicity concept? The periodicity concept says the economic life of the business is divided into intervals. The life of the business is divided into intervals, parts, and each part is called as an accounting period. This is called as the periodicity concept. The economic life of the business is divided into intervals, and each interval is called as an accounting period. Now, the question arises, why do we need to divide the life of the business into intervals called as accounting periods? The answer is, we need to know the results of our operations. We need to know whether our business is making profits or losses. I have done some business for 5 years, for 10 years. I want to know what is the profit the business is making. For that purpose, we divide the life of the business into intervals and we try to calculate the profits for each accounting period for each interval. Okay, now, first of all, how do you calculate exact profits? Now, a businessman has started a business and he has done the business for the last 20 years. He wants you to tell him what is the profit made by him exactly. So the businessman, he has done a business for 20 years and he wants you to tell him what is the profits made by him. Now, the businessman gives you some more information. He says, I set up the business 20 years ago by investing capital of 10 lakh rupees. 20 years ago, I had invested 10 lakh rupees in the business. And during the next 20 years, I have never introduced even a single rupee more. There was no further capital contribution. I never brought some more capital. I never withdrew even a single rupee from the business. So whatever profits were there, they were plucked back. They were left in the business and the business grew. So the businessman says that for the last 20 years he has been doing the business. When he started the business, he invested 10 lakhs rupees. He never introduced further capital into the business. He never withdrew even a single rupee from the business. Now, after 20 years, he has closed down the business and he tells you that I sold away all the assets of my business. I repaid all my creditors, all my bank loans. I have repaid everything. Now, I am left with 1 crore rupees. So, the businessman had started his business with a capital of 10 lakhs and now he is left with 1 crore rupees after 20 years. So, the exact profit which this businessman has made is 1 crore minus 10 lakhs. He has made exactly a profit of 90 lakhs rupees. This is the exact amount of profit which the businessman has made during the last 20 years. But now the question arises, is this information meaningful? Is this information meaningful? The business has been closed down. The information does not have any meaning at all. It does not have any use at all. Now, we cannot run after exact information. Exact profit information is of no use. Instead, what we want is, we want regular approximate information. So instead of waiting for the business to close down to find out how much exact profits you have got, it is better you calculate profit for each year. That is why most of the businessmen, they divide the life of the business into intervals called as accounting period, and generally that interval is 1 year. They try to measure what was the income generated for one accounting year and what were the expenses incurred for the same accounting year to calculate the profit for the business done during a particular year.